Thank you, Mr. Chairman. Welcome, Chair Gensler. We certainly appreciate you being here today. And when I was talking to some friends of mine yesterday about your appearance, they said, the APA director. And we both chuckled about that, but it makes the point that it seems as though your agency has taken on a different mission, that you seem to be pushing an ESG agenda, which is, in my mind, something that's not in the best interest or under your purview of the SEC. So I'll let my other colleagues get into that a little bit deeper, but I want to put something on record with regards to that. My first question deals with mortgage insurance-linked notes. According to the National Association of Realtors, the average first-time home buyer's down payment is 6%. In an environment of elevated interest rates and home prices, private mortgage insurance can make the difference between a family becoming homeowners or waiting years on the sidelines to amass a 20% down payment. At the same time, private mortgage insurance protects taxpayers by standing in front of credit losses at the GSEs in the event a borrower defaults on low down payment loans. Like other insurers, private mortgage insurers must manage capital positions and risk exposures on an ongoing basis. Mortgage insurers are in fact encouraged by state regulators and FHFA to manage that risk through purchase of traditional reinsurance and through capital market structures such as mortgage insurance-linked notes. However, SEC's recent reproposed conflicts of interest rule may unintentionally restrict the ability of private mortgage insurers to utilize mortgage insurance-linked notes as a risk management tool because the rule does not define the term synthetic asset-backed securitization. Chair Gensler, as the SEC continues to work on the conflict of interest rule, will you ensure that the final regulation does not cause unintended harm to the residential mortgage market by limiting the ability of mortgage insurers to utilize critical capital and risk management tools like mortgage insurance-linked notes?
This rule proposal is one of those, if I can call it, leftover mandates that Congress had put in place 13 years ago now in Dodd-Frank. So we put out a proposal to do that which Congress said, that if somebody was doing asset securitizations, they couldn't effectively trade against their investor clients, which is something Congress saw happening back in the 2008 crisis. And so we're committed to do that within the law, and obviously to take in the comments that you're talking about and sort through this.
Okay. Obviously, there's concerns about that, and hope that you'll be able to address those. Okay? Very good. Well, with regards to the banking crisis that we've had recently, I think it's an instructive moment from the standpoint of things that we maybe were not thinking about before. We saw with this crisis where somebody got on social media and within less than 2 days had $42 billion run off the books as a result of a social media tweet and the follow-ups from that. That got me to thinking and concerned, and in fact, this morning, the CEO for Charles Schwab, Paul Bettinger, voiced the same concern that I've been talking about for the last several days, which is about short selling. It would seem to me that if we have a situation where we have a lot of banks that are not very liquid right now, that there's some concerns about, that somebody could play some funny games with our not just the banking industry, but our economy as a whole. It could be somebody trying to make money. It could be a foreign actor who wants to do something different to our economy. So the question becomes, if you want to, so I guess what my question really is two parts. Number one, do you have the ability to stop a short sell problem that arises within the banking industry, for instance, based on its threat to the entire industry?
Both buying a security, going long, it's called, and shorting a security are an important parts of our capital markets and important parts of and are legal. To go both long and to go short, it's a way to express and help capital markets work. And so we facilitate that. What we guard against is people trading on material non-public information, and we guard against people doing manipulative acts in the market. So it's really...
well, my question is very simple. Do you have the authority to keep this abuse from happening, this manipulation from happening for the wrong reasons? Understand that it's part of the market structure, it's part of market investing, but if people are doing this to try and cause a run on the banks, to undermine our economy, undermine the industry for their own profit, or as a foreign actor to do something, do you have the ability to stop that? That's my question.
We most definitely have the authority and the ability to go after fraud and against manipulation in capital
Okay,
markets.
my question, though, do you have the authority to have a across-the-board ban on short selling so you could stop this from happening by people continuing to tweet?
I don't believe that Congress has given us that authority, sir. We've given authority to deal with individual acts of manipulation and chasing after fraud.
So much time has expired.
Okay, thank you very much. I'll yield back.